Welcome to The Deep Dive, the show that cuts through the noise of complex financial reports to give you the most important insights. Today, we're doing a deep dive into the first quarter fiscal year 2026 earnings conference call for ICICI Bank. We're going to, dissect the raw numbers, analyze what management had to say, and really try to piece together what it all means for their performance and outlook.
Yeah, exactly. Our mission is to strip away the jargon, the corporate speak, and really focus on the key figures and strategic shifts that actually matter to you. We want to offer a concise but thorough understanding. We'll be looking for those little signals that tell the real story behind the headlines.
Okay, so let's kick things off then with a high-level snapshot of ICICI Bank's Q1 FY26 performance. It really paints a picture of, pretty robust underlying strength.
Absolutely. The bank reported a pretty substantial 15.5% year-on-year growth in profit after tax. That hit 127.68 billion rupees.
Yeah.
And this isn't just, a healthy number. It really signals strong execution in their core banking operations.
Yeah.
Their core operating profit also saw a robust increase, 13.6% year-on-year, reaching 175.05 billion rupees.
And if we drill down just a bit, their profit before tax, even when you exclude the treasury stuff, it still grew by a solid 11.4% year-on-year. That's 156.90 billion rupees. So yeah, consistently strong numbers across the board on profitability.
Indeed. And on the balance sheet side, we see total deposits expanding by 12.8% year-on-year. Mm-hmm. And the overall loan portfolio, and this includes their international branches, grew by 11.5% year-on-year.
Okay.
So these figures suggest they're maintaining good traction, attracting both funding and lending opportunities. And
critically, how does their capital position look? Is it holding up?
Oh, yeah, very stable. The bank demonstrated strong capital adequacy. Their Tier 1 ratio was 16.31%, and the total capital adequacy ratio, or CAR, was 16.97% as of June 30th, 2025.
Right.
That's well above the regulatory requirements and, frankly, provides a very solid foundation for future growth.
Yeah.
And, resilience against any unforeseen shocks. It's always reassuring to see buffers that healthy.
Okay, so with that big picture in mind, let's unpack the profitability and margins a bit, because there are some interesting nuances here, aren't there? Beyond just the headline numbers. Net interest income, NII, increased by a healthy 10.6% year-on-year to 216.35 billion rupees. Fine. However, the net interest margin, the NIM, for the quarter was 4.34%. Now, that's actually down slightly from 4.41% last quarter and 4.36% in Q1 last year. So what's driving that slight compression? And what did management say about it?
Yeah, that's a crucial point. And what's fascinating here is the bank has actually changed its convention for computing NIM in other return ratios this quarter. They've shifted from using the actual number of days in a quarter to a number of months basis.
A change in methodology. Hold on. Why would they do that? And what's the real impact? Is it just making the numbers look better?
Well, management's stated reason is to eliminate that quarter-to-quarter volatility in NIM computations. Because quarters have different numbers of days.
Oh, right. Like February versus March.
Exactly. A quarter with fewer calendar days can sort of artificially depress NIM, even if the underlying performance is solid. So by standardizing to this number of months basis, they're aiming to present a smoother, more consistent NIM figure going forward. They did know the impact on the reported ratios this specific quarter was negligible. And they still expect the full year NIM to remain unchanged by this method shift.
Okay, so it's not just about smoothing numbers then. Maybe it's about signaling predictability to the market. Is that the idea?
That's likely part of it, yeah. It suggests a strategic focus on presenting a more stable earnings profile to investors, which can be particularly attractive in volatile markets. But it does raise an important question about comparability with past quarters, doesn't it? Mm-hmm. Though management seems confident it won't distort the big picture for the full year, it's subtle, but it's an important shift in how they communicate their core profitability.
Okay. And was there anything else impacting the NIM this quarter specifically?
Yes, actually. Management also highlighted a 7 basis point impact on NIMA this quarter. It came from interest on an income tax refund.
Ah, so like a one-off boost.
Pretty much. Sure. It's effectively non-recurring income that boosts their NII, but it's not from their core lending operations. So, without that, the underlying NIM would have been slightly lower still, maybe closer to 4.27%. And that's up from just 2 basis points last quarter from similar refunds. So it was a more significant factor this time around.
Right. That's a valuable distinction to make. Okay. So with NIM under a bit of pressure, underlying pressure perhaps, what does this tell us about their funding costs versus their loan yields? How are they managing that spread?
Good question. because the cost of deposits actually saw a notable decline this quarter, down to 4.85% from 5% last quarter. That's definitely a positive sign.
Okay, what drove that down?
It was primarily driven by strategic reductions in savings account interest rates back in May and June. We also saw the gradual repricing of their higher cost term deposits finally kicking in. And importantly, a reasonable reduction in their wholesale deposit book. Specifically, they trimmed some of those deposits raised at higher rates in the past.
Proactive management then.
Very much so. This proactive management of funding costs is clearly paying off.
Okay. And on the other side, the asset side, where they earn interest.
Right. On the asset side, approximately 53% of their domestic loans are linked to the repo rate. So for our listeners, the repo rate is basically the rate the central bank lends to commercial banks. A cut there directly impacts borrowing costs for customers.
Right.
Management expects the full impact of that recent 50 basis point repo rate cut in June to be felt more significantly in Q2. Previous cuts, they noted, have largely flowed through the system already.
So funding costs are coming down, but loan yields might follow, potentially squeezing that NIM further in Q2.
That's the dynamic, yeah. That creates that tension on the NII that they have to manage carefully.
Okay, shifting gears a bit, let's turn our attention to the loan book itself. That always tells a compelling story, right?
Yeah.
About where the bank is finding growth and what its strategic priorities are. The overall domestic loan portfolio grew by 12% year on year. Sequential growth was 1.5%. But here's where it gets really interesting, I thought. The business banking portfolio was a huge standout performer. It surged by an impressive 29.7% year on year and 3.7% sequentially. I mean, wow. What's driving that exceptional performance in that specific segment?
Yeah, no kidding. This business banking segment is undeniably a key growth engine for ICICI Bank right now. Management attributes its success to a powerful combination of things. Enhanced distribution means they're just reaching more businesses, streamlined processes, better digital interfaces for clients, and crucially, very tight credit monitoring.
So not just luck.
Definitely not accidental growth.
Yeah.
It seems like a very deliberate and well-executed strategy. They actually anticipate this segment will continue to grow faster than the overall loan book. So it's a critical area to watch for their future performance. It really demonstrates their ability to identify and capture opportunity in a specific high-growth niche.
Okay, so while business banking is clearly soaring, retail loans grew more modestly, 6.9% year on year. And looking closer at the components there, mortgages were up a solid 10.3%. That's decent, but personal loans, only 1.4% growth year on year. And credit cards actually declined 5.4% sequentially. So kind of a mixed bag in retail, wouldn't you say? What's the bank's take on these slower growing bits?
Yeah, definitely a mixed picture there. Management stated, quite directly actually, that they believe they can do more in both personal loans and credit cards, which suggests they see untapped potential, right? And are now focusing on improving distribution and maybe customer acquisition in these segments. They also express comfort with the quality of the loans they've originated over the past, say, 12 to 15 months, which indicates that while growth has slowed there, they haven't been sacrificing credit quality just to get volume.
Okay, but that raises an important question, though, doesn't it? Can they really ramp up these higher yielding but typically higher risk segments like personal loans and cards without eventually compromising their strong asset quality, especially after seeing sequential declines like that?
That's always a tightrope walk for any bank, isn't it?
Yeah.
Their confidence seems to stem from a couple of factors. One, their rigorous credit monitoring, which they kept highlighting. And two, the belief that the slowdown was more about distribution challenges or maybe market saturation rather than a fundamental credit quality issue with the borrowers they were getting. So if they can indeed do more by expanding their reach effectively without relaxing their underwriting standards, then yeah, these segments could become significant profit drivers again. It's an area where execution will be absolutely key. We'll definitely be watching for signs of that ramp up in future quarters.
Makes sense. And briefly on the corporate space, the domestic corporate portfolio grew by 7.5% year on year. Anything interesting there?
Yeah, management also discussed an interesting shift in their corporate loan mix. They've actually seen a reduction in the very high-rated, the AAA segments, and an increase in the A-rated segments.
Okay, shifting risk profile slightly.
Well, management views this A-rated segment as their sweet spot. They see it as balancing attractive risk-adjusted returns without taking on excessive risk. So it indicates a very deliberate and risk-calibrated approach to managing their corporate book. They're optimizing for profitability while maintaining that asset quality discipline. It's not just about chasing the biggest names. It seems like smart portfolio construction.
Okay. Now, a strong loan book is only as good as its asset quality. And ICICI Bank has historically been known for its discipline here. So let's unpack their credit performance this quarter. The net NPA ratio, the bad loan ratio after provisions, actually improved. It stood at 0.41% as of June 30th, down from 0.43% a year ago. That's good. And their provisioning coverage ratio on those non-performing loans remained robust at 75.3%. So on the surface, that sounds like good news, right?
It is good news on the surface, yes. However, gross NPA additions, so the new bad loans coming in, did increase year on year to 62.45 billion rupees. But, and this is important, you need to understand the context here, there's a known seasonality in Keys on Credit Card, or KCC, NPA additions.
The agricultural loans.
Exactly. They're typically higher in Q1 and Q3. For listeners maybe not familiar, KCCs are short-term agricultural loans, and their repayment cycles are often tied to harvest periods. So seeing higher additions in Q1 isn't necessarily a red flag. It's kind of a recurring pattern. Net additions to gross NPA after recoveries and upgrades were 30.34 billion rupees, which is still within expected ranges, especially given that seasonality.
So when you adjust for that KCC seasonality, what's the sort of the true underlying credit picture look like?
Well, if we try to connect the dots, the underlying credit cost, adjusted for that seasonality, seems to be running at about 50 basis points, or 0.5%.
Which is pretty good.
That's just a wrong number, yeah. Indicative of a well-managed portfolio overall. Management themselves characterize the current credit behavior and asset quality as extremely benign. They particularly highlighted the strong performance again in that granular business banking segment. They also made a point of clarifying something important. They do not restructure standard assets that are in default just to classify them as standard.
Right, no evergreening.
Exactly, which reinforces their disciplined approach and, frankly, their transparency. That's critical for investor confidence.
Definitely. Okay, moving beyond the core banking operations then. The bank is also heavily investing in its infrastructure, right? And its subsidiaries contribute significantly to the overall picture. Total deposits grew 12.8% year on year. Average current and savings account, CACO, deposits grew 8.7% year on year, and their average liquidity coverage ratio stood strong at about 128%. So plenty of liquidity there.
Indeed, very comfortable liquidity. On the operational side, operating expenses increased by 8.2% year on year. Management said this was partly due to the usual annual increments and promotions for their staff, normal course of business. They also expanded their branch network, adding 83 new branches this quarter alone. That brings the total to 7,066.
Still adding physical branches in this digital age.
It might seem counterintuitive, right? But for ICICI Bank, it seems to be about an omni-channel strategy, reaching customers in diverse geographies, providing that physical touch point alongside their digital services.
Makes sense.
And technology expenses, they accounted for about 10.7% of their operating expenses, which reflects that continued heavy investment in digital channels, cybersecurity, and operational resilience. It's just a crucial investment for long-term efficiency and competitiveness these days.
Absolutely. What about the performance of their key subsidiaries? How did they fare in the quarter?
Right. The consolidated profit after tax, so encompassing all their businesses, grew by a healthy 15.9% year on year, reaching 135.58 billion rupees. But it was a bit of a mixed bag at the individual subsidiary level. For instance, ICICI Life, the insurance arm, saw a decline in annualized premium equivalent, APE, and also the value of new business, VNB, year on year. But interestingly, its profit after tax actually grew.
Okay, wait. How does that work? Lower new business value, but higher profit.
Yeah, it's a good catch.
Yeah.
It's partly due to an accounting change they made. Starting back in October 2024, ICI Life's long-term products are accounted for on what they call a 1/n basis. Essentially, it means revenue recognition is spread out more evenly over the product's lifespan. This can smooth out reported earnings, but it makes those direct period-on-period comparisons tricky for specific metrics like APE or VNB, especially in the short term. So while those new business metrics were down, the underlying profitability in the quarter still improved, likely due to other factors like maybe better persistency or expense management.
Fascinating how accounting changes can really shift the narrative sometimes. Were there any standout performers among the subsidiaries then?
Absolutely. ICICI Home Finance demonstrated really impressive PAT growth. It soared from 1.17 billion rupees last year to 2.14 billion rupees this quarter.
Wow.
And ICICI General, the general insurance business, also saw a healthy increase in PAT. So this very performance, it really underscores the diversified nature of their consolidated business, doesn't it? While some parts face headwinds or accounting shifts, others really stepped up, which speaks to the resilience of their overall business model.
Right. Okay, so let's try and pull this all together. What does this deep dive into ICICI Bank's Q1 FY26 earnings truly mean for you as an investor or, just someone watching the market? What's the big takeaway?
Well, I think this analysis highlights a bank that is maintaining pretty disciplined growth. They're particularly leveraging that strong position in segments like business banking. And this is happening even as the broader credit growth environment faces maybe some softness, perhaps due to global economic factors or just slower domestic demand. So the bank seems to be very intentional about where it allocates its capital and resources.
And that strategic recalibration of their NIM reporting, even though the impact was negligible this quarter, it does indicate a move towards maybe more transparent and stable long-term reporting. It shows management is actively thinking about how they present performance.
I think so. And furthermore, the consistent focus on, risk-calibrated growth, prudent provisioning, keeping those NPAs in check, and maintaining high capital levels, that provides a very strong foundation. And their willingness to actively trim those higher cost wholesale deposits. That reflects a proactive approach to managing funding costs in what could be a dynamic, maybe even declining interest rate environment.
Which brings us back to that key question, doesn't it?
Exactly. How will they balance pursuing more aggressive growth in unsecured retail, like personal loans and cards, where they said they can do more, with their stated commitment to strong asset quality? The market is going to be watching the execution of that balancing act very, very closely in the coming quarters.
Okay, this is the part of the show where we put on our imaginary hedge fund analyst pitching to the investment committee hats. And remember, everyone, this is purely for entertainment and theoretical discussion. It is absolutely not financial advice, seriously.
Right. So given ICICI Bank's strong capital position, their disciplined credit management, we talked about underlying credit costs around 50 basis points,
Right.
and management's explicit confidence that they can do more in those high-yielding unsecured retail segments. Here's an outrageous but maybe plausible trade idea. Go long ICICI Bank.
Long ICICI Bank. Okay, tell me more. Why is that outrageous and plausible?
Well, the thesis is the market might be underestimating the bank's latent ability to actually accelerate growth in those high-yielding unsecured retail segments. The personal loans, the credit cards. Management explicitly said they're comfortable with the quality of loans they've written over the last year or so, and they're now specifically focusing on distribution.
Right.
The outrageous part of this idea is, well, you're betting on an acceleration in a segment that's currently showing sequential declines, right? And doing it in a generally soft demand environment. That's contrarian.
Definitely sounds outrageous. What makes it plausible then?
The plausible aspect comes from the bank's really robust capital buffers, their proven strong asset quality controls historically, and the potential for a significant upside surprise if they can unlock this growth without a material jump in credit costs beyond what they already manage. If, and it's an if, they can execute on this better distribution, good underwriting, the NIM expansion and the increased profitability from these segments could lead to a significant re-rating of the stock. So it's really a bet on their execution capabilities in a challenging but potentially very lucrative part of the market.
Interesting. A bet on execution. Okay, that wraps up our deep dive into ICICI Bank's Q1 FY26 earnings call. We've seen a picture of pretty consistent profitability, some smart strategic growth, especially in business banking and disciplined asset quality management, all while, navigating a dynamic market.
Yeah, the bank is clearly focused on that risk-calibrated expansion. They're excelling in business banking and very carefully managing the balance sheet and funding costs. It really is a testament to their strategic approach, I think.
We certainly hope this analysis has given you some valuable insights and helped you cut through some of the noise to understand what truly matters from this call. And as always, please remember, this information is purely for educational purposes and should definitely not be considered financial advice. What stood out to you from this earnings call? We'd genuinely love to hear your thoughts.
Yeah, absolutely. Until next time, keep digging into those numbers, keep asking questions, and remember, there's always more to learn.
Thanks for tuning in to The Deep Dive.